Hi, I'm Ed Whittingham, and you're listening to Energy versus Climate, the show where my co-hosts David Keith, Sarah Hastings-Simon, and I debate today's energy challenges, highlighting the Albertan and Canadian context. If this is your first time joining us, Energy versus Climate is a live webinar and podcast that drops every other week. Visit energyversusclimate.com to register for updates and get exclusive access to join our live webinars, ask us questions, and engage with us directly. On today's show, we talk about what it's going to take to decarbonize heavy industry. From cement to steel to petrochemicals, Canada has a lot of its economy wrapped up in heavy industry. What are some of the most promising technology and process solutions? What are the key opportunities and challenges on the path to decarbonizing heavy industry? What should governments do to help these sectors to decarbonize? To help us dig into that, we have special guest Thomas Coke-Blanc, Senior Principal at the Rocky Mountain Institute, where he leads their Global Breakthrough Technology Program. An engineer by training, Thomas built the very first McKinsey Marginal Abatement Cost Curve in 2005 and has extensive experience from on-site work with industrial facilities to improve productivity of energy, carbon, and other resources. He joined us from his home country of Sweden, which is also home to a unique joint effort to develop the first fossil-free steel, something we talk about. Now on to the show. Hello everyone, and welcome to episode 17 of Energy versus Climate. My name is Ed Whittingham, and I'm joined by my usual webinar co-host, David Keith and Sarah Hastings-Simon. From cement to steel to petrochemicals to mining, Canada has a lot of its economy wrapped up in heavy industry. Now, we know all pathways to net zero in Canada pass through heavy industry, or more specifically, heavy industries. And the cement and steel sectors alone account for over 10% of industrial emissions. Yet generally, as a country, we haven't really focused our collective attention on heavy industry GHGs compared to other sectors. It seems that oil and gas and electricity always hog the limelight. And of course, the gorilla in the room is often oil and gas, or more specifically, the oil sands, as it should be, because the oil and gas sector accounts for about a quarter of Canada's emissions. But purposely today, we're not talking about it. We're going to give heavy industry its due. What are some of the promising or most promising technology and process solutions? What are the key opportunities and challenges on the path to decarbonizing heavy industry? And most of all, what should governments do? To all you government officials tuning in today, that one's for you. So to help us, we've recruited Thomas Coke-Blanc. And Thomas is a senior principal at the Rocky Mountain Institute, where he leads its Global Breakthrough Technology Program. He's an engineer by education. And like Sarah, his steely business sense, pardon the pun, given the topic today, his steely business sense was forged by McKinsey and Company. And in fact, Thomas built the very first McKinsey Marginal Abatement Cost Curve in 2005. And for people in our line of work, that's actually a really big deal. Thomas is joining us from Stockholm, Sweden. Welcome, Thomas.
Thanks, Ed. Glad to be on the show.
So, Thomas, when we say decarbonizing heavy industry, which heavy industries in particular are we talking about?
So I think the typical bundle here is steel, cement, and petrochemicals. In the general term, heavy industry in this context.
Great. Now, when it comes to steel, cement, and petrochemicals, and I imagine we're going to get to all three in some way, shape, or form. When it comes to decarbonizing those industries, some people call them hard to abate. Why are they hard? Or the activist in me thinks, is that just a term to justify inaction? You can't reduce emissions in those industries because it's quote unquote hard.
Well, I think every sector has its own set of challenges. I think when we talk through this, you'll hear that there are a lot of similarities with the challenges you see in, for example, the utility industry. The biggest difference is that the utility industry by design is a regional, almost a national market that you can control with the nation state policies. When you look at specifically the steel industry and some other globally traded commodities, it's just from a policy perspective more challenging because there is very few effective actual sort of cross-national policy setting entities, right? But I think that what many think is the reason is twofold, which is that we really don't know what to do, that there is a lack of understanding of the technologies that could decarbonize, or that is really expensive, right? Those are two commonly quoted reasons why these sectors are hard to abate. You can't, for example, looking at utilities, you have a situation where renewables are coming down in cost, and you can see a clear pathway in most markets, unless they're already there. In some markets where the renewables are even cheaper than the fossil fuel alternatives, and that makes it easy to decarbonize because you have that line of sight on a solution that's lower cost than the traditional way of doing things. And I think the same holds true for electric vehicles, and the same holds true for use pumps for buildings instead of burning natural gas in many markets. So there is this notion that in the heavy industry space, you have more, it's not as easy to see the new solutions being cheaper. Now, I think there are a couple of other reasons why these sectors are hard to abate, and at least two that we focus a lot on in our work. And they're really sort of strong market forces that are driving productivity, and we need to turn them around in order to achieve abatement, right? So one of them is commoditization. So if you look at these sectors over time, there's been an increasing push towards creating these tradable commodities in a market that has and creates an international traded market where you try to reduce differentiation of the product that you're trading, so that you get higher volume, higher velocity. You can get a layer of traders involved in terms of controlling the price with futures and all kinds of mechanisms to control the price of the commodity. And in order to achieve that, you need to reduce the differentiation of the commodity. I think what a lot of the research is pointing to, that we need to do the opposite. We now need to create a differentiated commodity, call it green steel or green cement, that allows the consumer to understand that I'm now buying something different that has a different property than just cement, right? And that's going against the grain of a decades-long process of driving commoditization. I think the other market force we're up against is supply chain disintegration. So to take the steel example, 50 years ago, we used to have vertically integrated supply chains. So the same companies were owning the iron ore mines and the coking coal mines and the steel mills and the downstream cold rolling mills, and they owned the whole flow for a lot of strategic reasons: security of supply, locking in resilient supply. Could even be political reasons to secure supply of these materials for military reasons or other, right, infrastructure. And now we see a significantly more disintegrated supply chain. So iron ore is a separate asset class. Steelmaking is a separate asset class. And this is done for two reasons, partly because of the commoditization, and partly because the profit levels are different and the return on capital are different. So also from the investor community, these asset classes are viewed as different sort of risk categories of investment. The challenge here is that we now left with steel mills in the middle that are sitting on virtually all the emissions, but they're also the most competitive, least credit rated, and with least cash on hand. So we're putting the problem onto the asset class that has the least opportunity to do something about it. But if you go downstream or upstream, you have more opportunity to actually, invest yourself out of the problem. But generally, you're not invited to the table because policymakers talk to the emitting asset class. Yeah. So that's problem number 2, right?
Yeah. So I want to get to some specific examples. And steel is great because when I talk to the steel industry, they say we can decarbonize, but at $300 a ton. So at that price, we're going to pay even the Canadian carbon price of $170 a ton every day, all day, that our board will just pay compliance costs. And then cement says, yeah, we can decarbonize, but it's going to double the price of our cement, and we're going to be priced out of the market. But before we go to some of those challenges and on the flip side, opportunities, I just want to help people tuning in to understand, like, what are some of the specific technological pathways that we can use to decarbonize, and where do they overlap and where do they differ by sector? And starting with cement, my understanding, 60% of cement emissions come from calcination because of just the fundamentals of the thermochemical process. Limestone plus heat equals calcium oxide plus carbon dioxide. After cooking the lime out of the limestone, you get what you want, which is the lime, but you get a lot of what you don't want, which is the CO2. And it's close to a 1-to-1 relationship. You make a ton of cement, you get a ton of CO2. And to get to that point where you're cooking the lime out of the limestone, you need a lot of heat. And generally, that source of heat in the kiln comes from fossil fuels. So maybe starting just with cement, are we talking about carbon capture? Does it start and end with carbon capture as really the technological pathway to decarbonizing on the calcination part?
I think carbon capture is clearly an important technology for the cement industry. And I think that is for many reasons, right? And we can unpack them a little bit, one after the other. One is exactly what you're pointing at. And the benefit of using limestone as a starting point is that it's an abundantly available raw material to make cement out of. There are other formulas you can use, but then you set the industry up for raw material sourcing in a very different way than you do today. And cement is a surprisingly regionalized business compared to some of the other the heavy industry sectors. So I think you will get industry structural implications of choosing a different formula. And then there are customer challenges with changing formula as well, which is linking all the way to building codes. And I think there is a connection between the building codes, the structure of the construction industry, and the insurability of a building. So basically what I think, my view of what's happening is that while the project ownership of construction is a fairly consolidated market, the execution of construction is very fragmented. So many local contractors are hired in to do the job. Mm-hmm. And in order for them to, they don't have the balance sheet to carry the liability of something going wrong with a construction. So what they do is they insure themselves, and the only way the insurance company will underwrite the risk is if they follow code. So you have this loop which connects to the building codes that is a key enabler to sort of drive different technologies into the construction industry.
Gotcha. Okay.
Just can I jump in? I mean, isn't it true that there's now, which is kind of exciting, one plant in the world in Brevik, Norway, has actually now final investment decision committed to do CCS post-combustion capture on a cement plant to be operational in 2024, which is kind of exciting. Happy to have, if you have any knowledge about that. And your second comment was about, whether you can move away from limestone-based cement in bulk. No question you can do it at the margin. My impression from talking with people about this is, yes, I've heard the story about building codes before. I agree with everything you said, but that practical reality, the idea that we're actually going to move the main material flow completely away from limestone feels to me really unlikely. Am I wrong?
No, I don't think you're wrong. So I think the final technological opportunity here is something that's called using CO2 to pre-cure the cement in a centralized location rather than letting it cure after you cast it on the construction site, which actually reduces CO2 emissions because you can have the cement absorb some of the CO2 while you cure it, and this this requires carbon capture, but instead of storing it in the ground, you use it to pre-cure the cement. Now, again, this is also a slightly limited opportunity because it requires precasting, right? So
exactly. Why not why not do what's happening at Brevik? Isn't that, I guess, I always think about the simplest, dumbest thing. And it seems to me we know how to do this. We know how to store CO2 underground. We've been doing it for 50 years plus. The Brevik plant is being built. There will be some opportunities, but this precasting thing is just not going to grow that big. And it's got a bunch of cost factors that make it, to me, a little unscalable. Let
me just point out that David Keith, who has spent a chunk of his career working on CCS, has called it simple and dumb, which now I agree, there's no technological barrier to doing it. We'll get into the cost barriers and other things. But sorry, I wanted to interject, and back to you, Thomas.
No, I think you're right. I mean, the biggest challenge with CCS is the storage part, and we'll probably get to some additional complications there as well. I mean, there are other. First of all, it depends on your geological conditions, whether you can store or not, and there are other takers for that geological storage as well in the decarbonized economy. So it's not necessarily exclusive asset for the CCS industry to just utilize.
Yeah. So just quickly want to talk about steel and then want to get into key opportunities and challenges. So there are many of the same challenges as with cement. You melt iron ore at very high temperatures in the presence of oxygen and coke. You get what you want, which is steel, but again, what we don't want, which is CO2. But my understanding is it's very difficult to say bolt on carbon capture onto an existing steel mill. That really, at that point, you're looking at building a new steel mill. And of course, the steel producers will raise the flag and say, gee, you thought it was $300 a ton. Well, that price tag just went up. So what pathways do we have? And a shout out to you and your Swedish background, because there is one steel maker named Hybrid in Sweden that is substituting hydrogen and zero carbon electricity for coking coal and other fossil fuels in steel making.
Right. So the difference between steel and cement is that the raw material doesn't have carbon in it, right? So you do have oxygen in the iron ore, but you need a reducing agent to get the oxygen out, but you don't have any coal. So if you use another reducing agent, whether it's natural gas, which is both hydrogen and coal, you can get more oxygen out with less CO2. And if you use pure hydrogen, you can get the oxygen stripped out or reduced from the iron ore with virtually no CO2 associated. So you basically get water vapor as a byproduct now. So obviously that requires you to produce the hydrogen without CO2 emissions, which is a separate topic. But yeah, you can indeed run a process called direct reduction with hydrogen, and that's exactly what the Hybrid joint venture is doing. It's a joint venture between the state-owned utility, the state-owned mining company, and a arguably pretty close to state-owned steel company, even though it's a publicly noted company.
Yeah. So it's interesting. You'd said, well, we need that low carbon hydrogen, and that might work for a place like Sweden, where you've got a lot of low cost electricity, you got hydroelectricity, and you can produce that low carbon hydrogen. When I talk to the steel industry, they say the EU might be years ahead of us, and yet getting further ahead on hydrogen production and transmission, the low carbon kind, that's still a 20 to 30 year project. So I hear about this, but tell us, because in Canada and on this show, full disclosure, we've been quite critical of what we think are overly ambitious or irrationally exuberant hydrogen production schemes. But give us that EU sense. Is it closer than what we think?
Well, I think so. I'll give you the Swedish story first, right? So I think it's first of all, you need to keep in mind that the mining company is currently producing DRI pellets, which is and they have a magnetite ore, and they're producing DRI pellets, so it's already a pre-sintered product. So arguably, the marginal step to produce sponge iron from those DRI pellets is less than if you have a lump iron ore product. And we can go into all levels of detail on iron ore qualities here, but basically the marginal investment to get to sponge iron from the Swedish raw material is less well, arguably on Labrador Island, you're also pelletizing iron ore in Canada. So you have also pelletized product that could be a good starting point. Secondly, I'd say, we do have hydro. It's some 20% of our power mix. It's not, but it's all priced in the wholesale market much higher than the production cost from the hydro assets. So it's not as if these companies are tapping into low cost power. They're getting the same price as everyone else in the market. So it begs the question why they're doing it. And I think the rationale that has been described by the company itself is that, they're, rather than looking at the sort of added cost now, they're looking into whether their assets will be relevant in the market in 15, 20 years from now, and come to the conclusion strategically that, they will be much more relevant to the customers if they have a decarbonized product in 15, 20 years. So that's the rationale, and they're taking that strategic leap of faith. This joint venture is currently operating a pilot plant. They're building a full-scale commercial plant. They're just announced the location of it. Interestingly, the iron ore company in the joint venture has decided to forward integrate all their iron ore production into sponge iron, which is corresponding to 80% of European iron ore supply going into sponge iron over the next 20 years. And there are even new ventures coming into this, even if this sounds like a very crowded investment space for sponge iron, but you see additional ventures popping up. Like there was an announcement of a venture called H2 Green Steel. They're building a 5 million ton per annum fully integrated supply chain from iron ore to cold rolling, a completely new steelmaking asset supply chain.
Yeah, and interesting in making a strategic bet. Obviously, that to your earlier conversation about barriers, there will be a market. There will be market demand for that.
And what you're hearing from this joint venture, I guess, is which is slightly different from what you heard before, is that when they're actually doing this, they're seeing a less cost margin on the decarbonized product. They're talking about a 20% premium compared to traditional steelmaking. And if you then you have to ask yourself, what level of carbon price do you need to believe in for this to make sense? And I think, again, what they're saying themselves is if you have a carbon price up towards, between $80 and $100 per ton, or actually euros per ton, this will pencil. And that's CO2 prices that are definitely on the horizon for the EU ETS.
Great. Okay, Sarah. Eva, let's launch poll one. Poll one over to you. What's the biggest single barrier to decarbonizing Canada's heavy industry is? Cost, technology, policy, the lack of public pressure on producers. Sarah, over to you. Open it up and not specific to any one sector. What are the key opportunities and the key challenges on the path to decarbonizing heavy industry?
Maybe I'll start with the challenges and end on a more positive note, I guess. I think what I heard Thomas, saying a lot, there was this central message of, in a lot of cases, it's not the technology itself, which is not to say that there doesn't still need to be some technological development, but that really getting technologies deployed within the systems is a big challenge. And I think that's made harder within these larger systems where you do things in bigger chunks, say, compared with maybe making cars or making solar panels, where it's a little bit easier to get on this ramp of, producing a little bit less of something and then scaling up over time. You have this sort of minimum investment to get into when you're going to build a new steel plant, for example. And so that's, I think that's a challenge sort of in and of itself, but I think it also challenges the way that industries can innovate, right? Because even if you go back to the steel industry, which, we talk about how it's relatively highly emitting, I guess we should also note, of course, that it's a sector that has achieved relatively high recycling rates. So, I think that's worth noting and sort of learning from. And so one of the things I think that's interesting, though, from that lesson of, how they got to these high recycling rates and sort of this whole so-called mini mill system where you're using existing steel and basically remelting it down. That was not something, that originally came out of sort of the established big steel players, but in fact came from a player in the industry that was not in the steel manufacturing business, that needed steel for their own production of other items that were made out of steel, and was having a hard time getting enough steel, consistently. And so they went into this recycling in an effort to secure their supply, and not with an eye necessarily to selling it externally. And that's sort of the backstory of what has now become a large part of the steel industry as a whole. And so I tell that story because I think it's an interesting example of, sometimes or often, I guess, you have these innovations and disruptions that come not necessarily from, some of the big established players. And that's tricky to do within a system that is so it comes in such large chunks. I guess the one other challenge that I see, and I think we feel this very much in Alberta with all the debate around opening new mines for metallurgical coal, and in general, when we have these policy discussions where we talk about having carbon, output-based allocation systems that are protecting some of the trade-exposed industries, is really getting the timing right on this stuff. And so that applies for the coal plants, but it also applies for how far you push your local industry, because of course you don't want to get too far in Canada out ahead of the rest of the world, such that you're placing an undue burden and industries becoming uncompetitive. But we spend a lot of time talking about that. We don't talk so much about the flip side of the challenge, or the risk of not moving fast enough and ending up left behind with, plants that are no longer competitive, or producing, low carbon products that people want, or mines that are producing materials that are not desired. So those are some of the challenges side. If I think now then instead about the opportunities that come on the flip side of that, I see quite a lot of them in terms of, certainly as Thomas was talking about, creating these differentiated products. And I think we've seen that happen relatively successfully with renewable energy within consumer-facing sectors, where companies have, basically seen a value in making renewable energy commitments, even at times when it was at higher cost, and passing those costs on to consumers. And one of the key things there, I think, is that those costs, especially in the beginning, even if they were maybe high on a per kilowatt hour basis, they were low compared to the total cost of the product. So if you're buying something from Apple that has a renewable energy commitment, your iPhone, the amount of money that it costs them to buy renewable energy for that iPhone is a very small part of the total cost of the phone. And so I think there's opportunities for that similarly within, especially say the steel industry, where, you may have the cost of the product itself goes up, but if it's a small piece of the overall pie, there's a real opportunity there for Canada or other countries to be leaders in that space. And then I think the other piece of that, though, actually is there's sort of an opportunity or a little bit of potential for a reshuffling in some of the global layout of where these products are manufactured, right? So historically, coal plants, for example, they were cited, and steel plants were cited, and the industry as a whole developed on the basis of, the materials that were needed to produce that product. And so when we start talking about things like using hydrogen, or in the case of cement, using carbon capture and storage, whereas David and Thomas noted the storage geology is quite important, that kind of creates a little bit of a space for a reshuffling, which I guess, is a loss maybe for someone as some of these industries move around. But I think, bringing it back closer to home again with Canada and Alberta, it's sort of, it's an opportunity for us to look at some of these sectors with fresh eyes and say, where could we be competitive and even gain market shares in sectors that, we haven't been as big in previously.
Quick follow on to that. I completely agree with Sarah that this will reshuffle. That is, where things are depends on competitive advantage, and the competitive advantage shifts as we shift how we do it. So Ed mentioned there was skepticism about hydrogen. I have no skepticism at all about solar hydrogen. I think there's a really good chance that it happens at large scale as a significant fraction of primary energy. But it's going to happen in places that are really sunny, not Canada. And I think it will shift where it's economic and competitive to make some of these products. So if it really is true that we, solar hydrogen keeps going the way it's going, and that becomes a fundamentally cheap way to get carbon-free primary energy in general and hydrogen specifically, I think you're going to see production of ammonia and steel generally move to places with relatively cheap land, relatively cheap construction costs, and super high solar insulation.
And arguably, it will happen also where you have combination and asynchronic solar and wind production. So places like where you typically don't have a lot of industrial activity today, like the mountains of Morocco, where you can literally get capacity factors of 70+% by combining solar and wind. But currently, no one is developing any renewables there because there is no offtake, right? So I think,
and hopefully because of wanting to protect the environment. So I agree with you. I agree. I said solar, but solar and wind, of course. And there's places in carbon engineering. We actually saw some contracts in the U.S. Midwest that were close to 70% combined. I think I'm judging that wind plays a smaller role in global primary because of its environmental impacts and low energy density.
Right.
I think solar is really where it tips.
On land wind.
But that's partly because I'm assuming people will care more about the environment than maybe they actually do.
Let's go to the poll results quickly because, what are the biggest single barriers to decarbonizing heavy industry? Our audience says in order: cost, policy, lack of public pressure, technology, and cost and policy about a third each. So we've kicked around costs. Let's actually talk about policy, because what can governments do to try to help the industry decarbonize? We're going to launch another poll. There are a bunch of things that they can do, and a bunch of things. I can tell you, a live conversation within the government of Canada now, that there is more recognition of the need to go after this big wedge of Canadian emissions, and especially at a time when the Canadian government's international commitment to reduce GHGs just went up as of Earth Day, April 22nd, 2021. And so now we're going to be pulling GHG emissions reductions out of the back of the couch. We know already that the one thing that the government of Canada has, well, two things. They bet on the carbon price and going up to $170 per ton by 2030. And they've also bet on big subsidies. And by big subsidies, they've got a fund called the Net Zero Accelerator Fund, which came out of conversations with large emitters like steel and cement. And they just recapitalized in the last budget. It's gone from $3 billion to $8 billion. It's a good start, but even $8 billion for large industrial projects is not a lot of money over 5 years. We need serious money. We need more capital. We need long-term capital. But let's turn it back to our guest, Thomas. When you look at this and you go in and you've got the ear of a policymaker, what's your sort of 30-second elevator pitch on what the government needs to do? Or is it impossible to do in 30 seconds?
I'll try. I think one of the the final barriers that is relevant to consider is the fact that most of these assets are project financed, and you finance them under a certain policy environment, right? So I think it's important that you can create a stable policy environment that is investable against, so that that you have more. The challenge is not necessarily, one of the primary challenges is to what extent the different policies are bankable or not in your project financing case to your debt providers. And that's one of the key things we can focus on. And that maybe covers several of the responses in the poll here.
Great. We're going to get to... Go ahead.
I'll jump in. I think that's such an interesting one. It relates to something I know, Ed, that you, and maybe we'll talk about this more later, but this push to have a tax credit for CCS, right? And one might say, well, if we have a carbon price that's going to go to $170 a ton, why don't you have bankers out there that are willing to basically finance that price in the future? And as a CCS developer, you could benefit from that today. And the fact that there is that push for that, I think, is reflective of the fact that that finance tool doesn't exist. And we could debate, why is it there isn't enough faith in the policy durability, or there just isn't, a big enough market yet. I don't know. But I think that's rather than just direct subsidies, I do think that finding better ways to bring the financial system into the policy tools that have been developed already is really key. I think another one to me, I do think that the procurement one is a big one, especially when you're talking about governments, wanting to have industries develop locally. So thinking about both decarbonization and, the industrial development or jobs framing, where it's companies are going to end up going and locating, and there's a number of elements to that decision. But one is certainly, what does the local market look like? So I think that that's something that's quite important. And then I think just more generally coming back to that, like, how can governments help be the first mover that de-risks some of these projects, right? And I guess I get back on my industrial policy horse for the 10th time of these shows, to say, like, that's what we did in Alberta in the oil sands. And that's, more or less why we got SAG-D to happen, was because, government did it and showed that it worked. And then people took that up. And so I think that's just, we have to still recognize that, I think, Thomas, your explanation of the companies that are moving forwards that are, either state-owned or essentially state-owned, I think that reflects that reality. And it's not helpful if we try to pretend that we can just leave this completely to the market. I think once the technologies are proven out and, you've built the first one, maybe you can build the second or the third or the fourth and the fifth in the marketplace. And I think that makes a lot of sense. But those first projects, more direct involvement, not even necessarily in the form of subsidization, but really direct involvement, I think, is key.
Just to find a comment on that, Sarah, thank you. I think if from a policy perspective, the fact that the pilot plant was backed by the government to de-risk it, and there went a few $1 million maybe went in there. It's in the big scheme of things, peanuts. Because the state-owned company, which is, while state-owned, it's also publicly noted, and it's a for-profit company, they've now taken upon themselves to make a $50 billion investment. So if you look at the leverage they got from that de-risking, it's huge, right? And one more, I think, comment on policy. I think, the carbon price is interesting because in Europe, they've decided to lock the emissions and have a fluctuating price, while it seems like you guys have locked the price and have some uncertainty on the emission reduction. The challenge in Europe was that for many, many years, no one knew what the carbon price would be. So from a project financing perspective, it wasn't considered bankable, and everyone set it to zero in investment cases, like literally zero. No one banked on CO2 prices, so it had zero effects for new assets. It had some marginal effects in terms of fuel shifts and whatnot in existing assets, but really no impact in new investments. Now that's changing. Apparently, the market is more mature. They introduced the central bank function that can control the price a little bit, and so it doesn't fall through the floor. The futures market is evolved, so you can actually secure prices for a couple of years into your project. So there are a couple of mechanisms in place that makes it more bankable. And I guess that's what is happening here as well in Canada. If you have a specific price 10 years out and you know what it's going to be, you can actually put that into your investment case, and it becomes something that otherwise all the risk is going to fall back on the equity provider, right?
Yeah, absolutely, Thomas. And that's the issue in Canada. 2 words: political risk. So it's not bankable, or it's tough to make it financeable, because it sounds great and I applaud it, $170 by 2030, but we are one federal election away. And although the other party that could plausibly form government has come out with a much better climate plan as of a few weeks ago, it doesn't have that kind of aggressive price schedule. So you're trying to get that first plant financed. You're a steel manufacturer in Ontario. You got an old blast furnace. You want to replace it. You can say, sure, we'll replace it with existing technology and then hope to bring hydrogen in down the road. And whether it's 10 or 20 or 30 years, whatever it is, I'm not quite as optimistic as David on the electrolytic hydrogen, but we'll make it like hydrogen ready, but using conventional technology. Or we'll use electric arc furnaces and direct reduced iron. That's going to cost you, say, an extra $1.3 billion. Your base plan is $700 million for that retrofit, $2 billion to go to the next level of technology. And their point is at $300 a ton, 170 still doesn't get us there. It's risky. So the public good, the public funding is that $1.3 billion for us to ensure that we reduce our emissions. Now, government, are you going to buck up or you're not, or are you not? And part of the problem in Canada is green industrial policy is a toxic term here in North America, generally. Whereas I don't think it's the case.
And just to be very clear, the government doesn't have to push in all the $1.3 billion. They just have to push in whatever makes that investment whole. So we shouldn't inflate the issue by just saying the government should put all the capital in. They just need to put the marginal capital in or the marginal support to get from sub-market returns to market returns on that investment.
I totally agree. And I really want to agree with what Sarah said. Sarah keeps bringing up industrial policy. I think in a small country like Canada, you are sort of not allowed to talk about the reality that there's a limited number of plants and sites and get back to cement. Setting some overall unclear $170 price may not convince anybody to do anything. Yet if government really wanted to roll up its sleeves, maybe you have some kind of board that makes it so you're not just picking something and somebody's riding, but there's some board that fundamentally picks a site and then works to get that site actually to do it. Why is the first plant in Brevik not in Canada? And that's because government didn't get it together to just work to get something real done. We want to have these policies that appear to be even-handed, but really mean we won't do much.
Yeah, and if I could add to that, one of the reasons in Canada, we don't talk about this enough, is that the steel and cement sectors, by example, don't have a home in the Canadian government. We've got branches within natural resources for oil and gas, for mining, for forestry, teams that wake up in the morning thinking about how are we going to decarbonize those industries. I don't think you've got a single person in the government of Canada, fill my email inbox if I've got this wrong. I don't think you have a single person waking up each morning thinking, how do I decarbonize steel or how do I decarbonize cement? And until we get that kind of focus on it and we build out those teams, then it's always going to be off the side of someone's desk who needs to make key policy decisions to help those sectors. I want to get us to questions. We've got lots of questions that have come in. We've got 20 minutes. We've got Nicole Chan. You're going to ask us a question. Over to you.
So I just have a quick question, or maybe not so quick, but cement plants can use natural gas to get to the temperatures that they need in their process. And so do you see maybe renewable natural gas playing a role in the decarbonization pathway for cement plants?
Thomas, do you want to take a crack?
I can take a crack. Thank you for the question. It's slightly outside of my area of expertise. I think the short answer is yes. I would just add some caution around some of the challenges involved with the RNG supply chain. So not only on the sustainable biomass supply at large scale, but also on the upstream emissions. So similarly to natural gas, methane from RNG leaking has the same impact as methane leaking from a fossil source. So obviously, you need to make sure that it's a tight supply chain.
Yeah, I'll add in. I mean, the answer is if you've got RNG magically in large quantities, other than the methane leakage, then yes, it works perfectly for this. If the RNG was carbon neutral, but I think the issue is RNG really something that's plausibly scalable if RNG means from biofuels? And is it better than other things we could do with biofuels, given a certain amount of environmental impact we're willing to tolerate? So to be clear, we could do a huge amount of biofuels in Canada if we don't care about the environment. But if we limit ourselves to some environmental impact, it's hard. And with the biofuels we have, my sense is we might be better to do co-firing with CCS to get some hard carbon removal and use it to deal with intermittency of electricity supply and not bother to change it into gas, but just keep it as a variable electric source with CCS.
And I would broadly agree. I think there is, if you look at all the sectorial roadmaps that you can find, Google it and find one and look at it. There's a tendency for every sector to subscribe to biofuels as a part of their decarbonization pathway. If you add them up all together, biomass in general is frightfully oversubscribed.
Great. I want to get to another question. Marcus Lehman, we depend upon generational old processes for cement and steel production. How can we dedicate the necessary resources to shift the mindset, creating, implementing, executing processes such as LC3, limestone, calcined clay cement, or similar? And I will say, I mean, in the Canadian context, generally used limestone, or also known as Portland lime cement, It's 40 years old. It's been in the EU for decades. It took 10 years to get it adopted in Canada. It was a horrendous process. And then once it was accepted, we still needed to get architects and engineers to wrap their heads around actually using it, even if there's no technical reason against using it. It was purely behavioral. It's cost effective. You get the same performance. And you've got this dichotomy of downtown office towers in Vancouver who use general use limestone. And here in Alberta, there's a lot of hesitancy. So with that as a long preamble, Sarah, what do you think we need to do?
I guess I'll just start by agreeing that this is a real challenge. And as you say, I think it's one of the parts that makes it challenging to me is that you have to separate the real concerns about, yes, when you build a bridge or a building, we do need to be concerned that it's going to stay standing, from the, tendency to not want to, change the way things are done. And so it's sort of, how do you get that right, that you're not going too far from one way or the other? I guess I would say one of the other pieces of that as well too is actually going even a step further and changing, the materials that are used. So like, where should we be using lumber in place of cement or steel in buildings? And I mean, that's something that's also an opportunity, and I think being investigated with in Canada now, and also comes back to that kind of behavioral issue within the decision makers who are, designing buildings and things like that. So how do you do that? I mean, I think it comes back to me to that government regulation and procurement piece in a major way, right? So like, how do you demonstrate that some of the, where it is makes sense and where you can do it, demonstrate that these things work. Governments do build and own a lot of infrastructure. And so there's opportunities to do that. And then finding ways to have building codes and processes that, update more quickly to be able to, integrate these new materials as it becomes clear what we can do with them, or these new processes, I think is another important piece of it. And so it's having those building codes and then having alongside with that, the necessary training and education for the contractors and people that are actually deploying this stuff out there. So I think it's a combination of those, but it's really a tricky part. And to me, that's a big part of where the challenge really comes from in this sector.
Yeah. And plus one, Sarah, on government procurement, I think it could be a huge tool. Do want to give a shout out to Rebecca Dell on the interchange, because to your point of, the slow adoption rate in particularly construction, she had this great, and if you haven't heard it, please go look at the interchange and Rebecca Dell's interview there. She had this great story. Yeah, you can come to a builder and say, I want to build this bridge. And, let's say we're using concrete for it. And here's a theoretical chemistry that I think will have lower carbon. And she said, well, that's great. You use it, you build it, wait 40 years, then we're going to come and have a look to see whether that bridge is still performing. And that's the big barrier within a fairly conservative construction industry. And a barrier, frankly, because when I talk to, going back to government, the good folks at Infrastructure Canada, they're under a lot of pressure to help to provinces and municipalities to rebuild their infrastructure. That uses a lot of cement and concrete, but at the same time, they're already attaching green strings. They're worried that with the political pressure to get that money out the door, it's tough for them to attach another green string, like you have to be using low carbon cement or low carbon steel.
I think also, speaking of infrastructure, I think we tend to underestimate the amount of energy we are consuming through fossil fuels. If you look at the total current global electricity system, 25,000 terawatt hours per year, just from population growth and economic growth, that's probably going to double by 2050, roughly, according to IEA. If we want to electrify industry, we need another current global energy system for power on top of that. So we'll be looking at not growing, not building 100% renewables. Looking at the current system, we need to go to 300, right? So the electrification challenge is quite daunting. And the good example is here in Sweden, where one industry, the iron ore industry, decided to electrify the reduction of their product. And we are currently, that one company will consume more than a third of the whole country's electricity. And that's huge.
Exactly.
They're adding 10 gigawatts of load on a system that has a peak capacity of 40 gigawatts. So, and they're putting it all in one location, which is completely turning upside down the whole grid planning. One company's decision to electrify.
Let's talk. Let's go back to CCS. We have a question there, and remember we talked about Heidelberg Cement installing the world's first full-scale CCS facility at a cement plant in Norway. A shout out to Lehigh Cement. There's a feasibility analysis underway on CCS at its plant in Edmonton, Alberta. A question here came in from Fernando Mellon. Thank you, Fernando. Would a federally funded CCUS industrial hub system that connects a series of industrial sites to a network be a viable option for a Canadian industrial decarbonization strategy? So again, focusing on CCS's applicability to, say, cement, steel, and petrochemicals.
So I guess I'll maybe just start by noting, we have pieces of that, right? We do have this carbon trunk line in Alberta that was built with, I guess, I know Albertan funding. I'm actually not sure to what extent there was federal funding in there as part of it. So I do think that, these questions of like, what is the infrastructure that you need around industries to move, say, the CO2 from one place to another. I do think that is potentially a very good role and use of public funds, as opposed to, say, directly subsidizing, as we were talking about previously. I think that one of the sort of issues or one of the things to look out for when doing it is, though, that you have to be careful to kind of balance, I guess, the carrot and sticks appropriately. So, you can provide the infrastructure, but then you also have to have the policies that are in place that are going to kind of, force people or kind of drive them towards actually using it at the end of the day. So it's not enough to just, build things.
And I think building here, in my mind, there's, again, taking the view of the investor. The pipeline infrastructure, whether it's for hydrogen or CO2, is challenging also from the utilization perspective, because increments of scale of whoever puts in or takes out product from the pipeline comes in vastly different sizes. So, you look at hydrogen buses, you need roughly 100,000 hydrogen buses to equate to one steel mill. So they come in really different sizes, and the pipeline is an order of magnitude larger. It equates to like 10 gigawatts of electrolyzer load. So you're going to look at investing in a pipeline infrastructure with a very unpredictable utilization, right? And that does not make a good business case for investment. So there is a role here, not necessarily to pay for everything, but to sort of support, I think, neck-to-neck development of supply and demand, right? To make sure that you don't overbuild supply and you have, this whole utilization upstream, midstream, and downstream, and balancing that over time is, I think, really value-adding to enable investment.
Great. And Thomas, in terms of that neck-and-neck development, so we're hearing a lot of talk about border carbon adjustments now in Canada. And by the border, we're thinking of not just Canada, we're thinking North American wide, because cement or steel producers say, we can do all this, but not if we're just going to be outcompeted by cheap imports and a bunch of steel dumping. Tell us, give us a sense of what is the EU situation around that?
The EU is talking about introducing a border adjustment tax already by 2023, I think, so really soon, partly to protect the inner market, where the carbon price is being really ratcheted up in terms of allocation versus what you have to buy on the auction for a steel mill, for example. I think my personal view of the challenge here is that very similarly to when you go in and write policy for different asset classes for who gets what allocation of free emission rights, which has been a decades-long debate in the European Union, you're starting to classify assets. In this case, you're going to have to start to classify products, and you're going to have to create some level of reference benchmark for what's good or what's bad, because the accounting methodology of tracking what the true embedded carbon in a product is really short, is not very good. And you also have, again, going back to the strong market force towards commoditization, the market wants that, the market doesn't want differentiated products. So there is this, once you put something on the seaborne market, you sort of lose track of a lot of the attributes of the product. And then you're introducing now a border tax on these products. And either you need to enable tracking upstream all the way to the source, which is challenging, or you're going to have to classify the product in whether it's a pellet or a sponge iron or a steel billet, or if it's whatever level of refinement you have the steel in, and you're going to have to put a tax on that product classification. And that's ample ground for lobbying. And it might just be a complete disaster in terms of timeline to agree on something that you can implement.
Great. Okay, well, let's dive into another topic that is highly susceptible to lobbying, including right now. So going back to Canada's carbon pricing system. And our carbon pricing system focuses on incremental GHG increases. I think incremental, marginal, and you as the architect of the McKinsey marginal abatement cost curve, compare that to a system that's just a flat out carbon price on all emissions. The question from Roman Zombak, and sorry if I've messed up your last name, Roman, is how helpful is that style of carbon pricing on the incremental GHG increase relative to another style of carbon pricing for heavy industry decarbonization?
So I think it's exactly the challenge of this. Someone has to decide what your baseline is that you measure marginal increase from, which is there are a lot of details you can muck around with in order to change that number, right? And look, ultimately, I think it would be beneficial to tax the consumer, not the producer. From a conceptual perspective, that would create the price signal at the consumer level that will be able to pull a more expensive product through. I think that's just unpractical because tracking of carbon emissions through the life cycle here is very hard. So we've fallen back on taxing assets on the producing side, and then arguably it's from a policy implementation perspective, it's easier to tax all the emissions. From a industry political perspective, that comes with a lot of challenges because it suggests sort of a step change in your cost structure.
I think it's somewhat problematic the way that, we've landed on that within Canada and within Alberta. I mean, I think, I don't want to be overly picky because I think there's a lot of great things about the carbon pricing system and raising the price where the price is going to. But I do think, that this idea of having output-based allocation, so a portion of the emissions that are not charged for emissions-intensive trade-exposed industries has been a little bit perverted in its application. So starting with the idea that, the concept of identifying emissions intensive and trade exposed industries was really originally intended to be, okay, that gives you a first list, which you then from that point go through and decide, which ones really need some form of output based allocation to, protect them from carbon leakage. And that has really just transformed into, okay, as long as you, meet those emissions intensive and trade exposed, then you're on the list. And so I think that there's a lot more allocations going out than, would need to be to avoid carbon leakage. And then you can say, well, the economists would say that's not problematic because as long as the marginal price remains the same, then you get the response that you want anyway. And there, I think that just really doesn't reflect, the way the systems and the people and the way that these companies operate, in that there's very much, a sort of issue of salience and prices and costs getting to a certain level before it gets the attention of, management and becomes kind of an issue to deal with, right? And I think there's some, there's some good work that has been done looking at actually the EU ETS that shows that, there are definitely companies that responded, especially this was at a time when I think the allocation levels were higher, but they essentially responded to those, the price with the allocation level much more like a regulation. So basically they, would decrease emissions down to the level of the free allocations, but not below. So I think there's a lot of evidence, that when you put this, very nice conceptual concept around marginal cost into the real systems of companies, they don't quite respond in the way that, we might like. And so I think that is something that, is important to reevaluate. And I guess the one thing that, hopefully border carbon adjustments are one way to address those. The other is that, if we do start to, as I think we're starting to see, more coordinated global action from, the US, EU, China, then, that problem starts to a little bit go away on its own, because you basically, have the majority of areas where you're doing this stuff, are all having some sort of policy.
Yeah. And I want to
the other is what I would refer to almost sometimes refer to as the fair trade coffee approach, which is don't track, just certify the source and enable the consumer to have a certified source of origin of the material. And that just, that is maybe not all appropriate for all applications, but for some of these commodities, a certification of origin approach could actually be helpful and avoid some of the complications that we've just talked about.
Yeah. And I want to add just one point about Canada's approach to pricing carbon, because not only is it on the margins under our system that you only, as an obligated party, when you tally up your emissions reductions obligation, only 25% of that actually needs to come from direct emissions reductions. Right now, we've designed a system that's got a 75% allocation for offsets or for some kind of compliance payment, which means that we need an offset system with a high level of integrity. And right now, to its credit, the feds have rejected pretty much all the provincial protocols. But we need to ensure, if we're going to have that big of an allocation, 75% to offsets, protocols that have high additionality and high permanence. And you only have to go back to our nature-based climate solutions conversation a few episodes ago to know that we had a serious conversation, or we raised serious concerns about both those things, additionality and permanence. We are at the top of the hour. So I think it's time to wrap up. Thomas, I want to thank you for joining us. I know it's late your time in Sweden. So you've gone above and beyond the call of duty to join us. Thank you very much. We appreciated having you on Energy versus Climate.
Thanks for having me.
Thank you very much.
Great. Now, remember, this episode is going to be available at energyversusclimate.com or available for downloads on Apple Podcasts, Stitcher, Spotify, or wherever else you listen. Our next episode is on May 20th, and we're excited about this because we have climate scientist and former Green Party of BC leader Andrew Weaver, who is going to talk to us about his experience moving from science to politics and now back to science. So I think that's going to be a really interesting conversation. And before we ring off, a shout out to our colleague Sarah here. On Wednesday, the British High Commission and the Canada Climate Law Initiative announced 26 Canadian climate champions, including notables like the Canadian Minister of Infrastructure and Communities, Catherine McKenna, David Suzuki, and our very own Sarah Hastings-Simon. So congrats to you, Sarah. Yeah, you didn't know I was going to give you that shout out.
No.
Look forward to seeing you on May 20th, a couple of weeks' time, with Andrew Weaver. Take care. Thanks for listening to Energy versus Climate. The show is created by David Keith, Sarah Hastings-Simon, and me, Ed Whittingham, and produced by Eva Wojnijescu. Mika McFarlane provides webinar support. Our title and show music is The Wind-Up by Brian Lips. Sign up for updates and exclusive webinar access at energyversusclimate.com. Interact with us live every other week and subscribe to the podcast on Apple Podcasts, Stitcher, Spotify, or wherever you listen.